I think the fundamentals changed on August 2nd, and I think the Fed has probably blown their chance to get inflation under control. So let me show you what I'm talking about here. This is the dollar, and I'm going to show you the dollar cycles. So we've got an intermediate cycle low right here, got an intermediate cycle low right here, and I think we had the potential for an intermediate cycle low right here. This fulfilled all the normal parameters for an ICL. It broke the trend line, and we made a lower low. So we've got a failed daily cycle. And I think, barring the fundamental change, I think this would have turned out to have been an intermediate cycle low, and then the dollar would have continued to rally. But what happened, of course, is that the stock market started to crash. And I think right here on August 2nd, I think the Fed panicked and they opted for rescuing the stock market and taking their chances with inflation. And so let me zoom in here a little bit. And so what happened, instead of the dollar continuing to strengthen and starting a new intermediate cycle, it crashed. And then it continued to crash the next day with a small rebound, and now it's continuing to crash. I think this is telling you that the Fed has panicked. They've flooded the markets with liquidity. That's why the dollar is starting to crash. And they aborted what would have been an intermediate cycle low and a new intermediate rally. If they had not done this, the dollar would have rallied, stocks would have continued to crash, probably into a 4-year cycle low. That would have infected everything, including gold. We would have gotten probably a drop to retest 2100 in that scenario. But the fundamentals changed on August 2nd. The fundamentals changed. The Fed blinked. They opted for rescuing the stock market, rescuing the financial system, and taking their chances with inflation. And a lot of people want to try and spin this, but the reality is, here's the reality. I'm going to go to gold. April 12th. This is when the easy phase ended, and I warned people that that we were gonna, one of two things would have to happen. The easy phase was done. This strong trending phase, that was done. So one of two things had to happen. Either gold had to give us a sharp correction back down, or it had to churn sideways, and as it turns out, gold churned sideways. And during this period, both sides get taken to the woodshed. Bulls, bears, it doesn't matter. Both sides lose money because the market is just whipsawing and erratic. There's no trend. And about the time you think a trend is getting ready to start, then it reverses and goes in the other direction. And I warned subs during this entire period is bet small, don't take any big losses. Just make sure you keep your portfolio more or less intact, and we're going to get through this difficult phase, and then there'll be another easy phase like this. So as long as you get through this without doing any serious damage to your portfolio, then when the next easy phase starts, you'll have most of your gains intact, and then you'll be able to add to it. And so that's what I've been trying to do here. And we have taken some losses, but no huge losses. Granted, if people listen to me and didn't bet huge, didn't leverage, then the small losses either have already been recovered or will be recovered, and very quickly during this next easy phase. So as I said, the fundamentals changed on August 2nd. So that was the point at which we've had one test of 2,500, and then the second test of 2,500, and a third test, and now we've broken out, and I said the other day, I'm pretty sure this breakout's going to hold, and we're now starting the next easy phase. So, people can spin this however they want, but I was correct. We entered a difficult phase. Bulls and bears both lost money during this phase, and the people that listened to me and followed my advice, bet small, didn't take any big losses. Now they are, we are set up and prepared to be aggressive during the next easy phase, and by the end of the year, I think we'll probably have one of, if not our best year ever in the S&T. So that's what I think is happening. I think the fundamentals in the market changed on August 2nd. I think the Fed panicked. They aborted the crash that was set up to happen in the stock market, which would have taken down everything. And in the process of aborting that, they've probably unleashed the inflation genie again. And over the coming months and next several years, it's probably going to get really bad inflation all over again. And if the administration tries to impose price controls, oh my God, it'll be so much worse. So this is, as it always is, this is about recognizing what kind of market you're in. When you're in an easy phase, you want to be bold, you want to step on the gas, you want to be aggressive. When you transition into a difficult phase, you want to be cautious, you want to bet small, you want to make sure losses are not very big and can be easily recovered. I recognized the easy phase here. We took advantage of it. I warned people we were in a difficult phase here. We were cautious. And now I'm pretty sure we're in a new easy phase, and we are aggressive again. And by the way, this probably means that the Fed is going to slow down the rollover into the recession in the stock market. If the crash had occurred, I think we would almost immediately enter a recession, but then the Fed would start printing heavily, and we'd probably come out of the recession quickly. They flooded the system with liquidity, so I think it's going to be a much slower process of rolling over into the recession. And we'll probably get, let me pull up the stock market. We'll probably get either a rolling top that takes many months to top out and roll over, and then we'll get our next 4-year cycle low in like 27 or 28. Or we could have a megaphone topping pattern where you get, and that kind of looks like maybe this is what's happening, where you get, the warning shot across the bow here, and then the Fed comes to the rescue, pumps a lot of liquidity, and you get another move that comes up and makes a higher high, and then you get at some point you get another crash scenario that comes down and makes a lower low, and so you get a series of higher highs and higher lows. So this expanding megaphone type pattern that eventually rolls over and crashes to the downside. So that's definitely a possibility, and it kind of looks like maybe that's what's playing out here with this violent rally back to the upside. This is not from natural buying. This is from the Fed flooding billions and billions of dollars into the financial markets, and that's what triggers this kind of a move, along with short covering. So, one or the other, either a rolling top that takes many months to top out, roll over, and then start to crash, or a megaphone pattern, which is kind of similar, but it's a really volatile, erratic pattern where the fundamentals are trying to take the market down, and the Fed's trying to fight it by flooding liquidity into the markets. And if that liquidity starts to flow more and more into commodities, then that's where we will get another spike in inflation. So I think the fundamentals changed, and I think the Fed has opted for taking the risk of inflation as opposed to letting the stock market crash and the recession to begin immediately.